Welcome to Value Vest Daily, where we deep dive into the best value and momentum investment opportunities. Today, we're looking at a fascinating and, I think, overlooked oncology company. They're taking on one of the toughest fights in all of medicine, brain cancer. The company is KZIA Therapeutics, ticker KZIA. And the big question we're tackling is this: could their unique science make this the hidden brain cancer stock that's set to 5x or even more by 2030? Let's find out. All right, here's how we're going to break it all down for you today. First, we'll get a real sense of the enemy here. What makes brain cancer so tough? Then, we'll dive into KZIA's incredible science. This is the really exciting part. After that, we'll decode the financials, see who's investing in this thing, project the potential returns, what we're all here for, right? And finally, I'll give you my final verdict. It's going to be a deep one, so let's jump right in. So first things first, we have to understand the challenge. We're not talking about just any cancer. We're talking about monsters like glioblastoma. It's one of the most aggressive and deadly brain cancers out there. And honestly, for decades, treatment hasn't really changed much, which has left patients with a really grim prognosis. This huge unmet medical need, well, that's the battleground where KZIA is making its stand. And here's our contender, KZIA Therapeutics. They're a biotech firm with a laser focus on these truly challenging cancers. And their goal isn't just to add another few weeks to someone's life. They're aiming to completely rewrite the rulebook and fundamentally change the outcome for patients. It's a bold mission. Okay, now for what I think is the most critical part of this story, the science. This is where we find KZIA's secret weapon, its main competitive advantage, or what we investors call its moat. So how are they planning to win where so many others have failed? Well, it all comes down to figuring out how to unlock a fortress. You see, the biggest problem in treating brain tumors has a name, the blood-brain barrier, or BBB for short. It's basically nature's perfect security system for our most important organ. It's fantastic at keeping out germs and toxins, but there's a huge downside. It also blocks more than 98% of potential medicines from ever getting into the brain to do their job. This is the perfect way to think about it. The brain is this heavily guarded, impenetrable fortress, and that blood-brain barrier, that's the massive, unbreachable wall around it. The tumor is the bad guy inside the walls, but your army, all your cancer drugs, are stuck outside, unable to get in. And this slide right here shows you KZIA's entire game plan. On the left, you've got most cancer drugs. They get to the wall and, nope, they're blocked. Game over. But KZIA's lead drug, paxilocidib, is completely different. It was engineered from day one to be the secret key. It's a molecule designed specifically to be able to unlock that gate, cross the barrier, and get inside the fortress. This is its moat. It's not just another drug. It's a delivery system that gets to a target no one else can reach. And this isn't just a cool idea. The data is starting to prove it out. Paxilocidib has already shown a 33% improvement in overall survival for a particularly hard-to-treat group of glioblastoma patients. I mean, that's huge. The FDA has definitely taken notice, giving it a bunch of special statuses like fast track and orphan drug to help speed things along. Plus, it seems to work well with other therapies, which could make it a future cornerstone of brain cancer treatment. So, the science is absolutely compelling, but we're investors, right? So we have to ask, does it translate into a solid investment? Let's switch gears and decode the numbers behind the science. What's KZIA's financial health actually look like? Now, if you're new to biotech, you might look at this and see a sea of red flags. The market cap is in that small cap range, around 380 to 550 million. But then you see stuff like PE, return on equity, free cash flow, and they're all negative. But here's the thing. This is totally normal. This is the classic playbook for a clinical stage biotech. They don't have a product on the market yet. They're pouring every single dollar into research and development to get that drug approved. The value here isn't in today's earnings. It's all about the massive future potential. So yes, they are burning cash to fuel these groundbreaking trials. That's the cost of innovation in this space. The big question for investors is what we call their cash runway. Basically, do they have enough money in the bank to hit their next big milestone? That's why we'll be watching their next earnings call, expected in late February 2026, very, very closely. You know, investing in a company like this, it's a real bet on the future. So a great way to build confidence is to ask, who else is making this same bet with me? So let's take a look and see if the smart money, we're talking big institutional investors, is getting involved. And what we find is really encouraging. A full 35% of KZIA is owned by institutional investors. Now, for a small biotech company, that is a really significant number. It tells you that large, sophisticated funds with their own teams of scientists and financial analysts have kicked the tires, looked at the data, and decided, yep, we want a piece of this. But it gets even better. We're seeing some really positive moves just recently. Big players like Barclays have been buying more shares. And check this out. Back in August 2025, KZIA did what's called a PIPE financing deal. Now, what's so incredibly bullish about this is that these institutions invested at a premium to the market price. Let me say that again. They didn't ask for a discount. They were so eager to get in that they paid more than what the stock was trading for. That is a massive, massive vote of confidence. All right, this is the section I know everyone's been waiting for. We've got the promising science, we've got the smart money backing it up. So, what could this all mean for the stock price? Let's look at the charts and the analyst targets and try to project the potential returns here. So, from a pure chart perspective, things are starting to look really interesting. After being in a slump for a long time, the stock recently broke out of its long-term downtrend. That's a huge signal for traders that the momentum might be shifting. We're seeing a solid floor of support around the $5 mark with some key resistance levels up ahead. If it can break through those, we could see a serious move up. Okay, so what are the pros saying? The analysts who cover this stock have a consensus price target over the next 12 months in the $14 to $16 range. Now, compared to where it's been trading recently, that's a pretty substantial upside right off the bat. But the real story, the real potential for life-changing returns is longer term. If, and it's a big if, Paxlovid gets that FDA approval and actually hits the market, the analyst targets for the next 3 years jump into the $20 to $30 range, and frankly, some think it could go even higher. This is the home run scenario. So let's put that in real-world terms. What does that actually look like? Well, based on the middle of that 3-year target range, a hypothetical $10,000 investment made today could potentially grow to become $25,000. Now, that is a powerful potential return. But remember, it is completely dependent on the company executing its plan and getting through all the clinical and regulatory hurdles. So, we've laid out the massive opportunity pretty clearly. But to make a smart decision, we have to be just as clear about the risks involved. So let's bring it all home with the final verdict, balancing that huge potential upside against some very real challenges. Let's just put everything on the scales. On one side, you have this enormous potential. It's driven by what looks like groundbreaking science, and there are multiple upcoming catalysts, like data readouts, that could send the stock soaring. But on the other side, the risks are just as real. Clinical trials can and do fail. They'll likely need to raise more money, which could dilute shareholder value, and they're burning through cash. This is the absolute definition of a high-risk, high-reward investment. And of course, I have to say this. None of what you've heard today is financial advice. This is for informational and educational purposes only. You should always do your own research and talk to a professional financial advisor before making any investment decisions. Seriously. If you found this deep dive helpful and it gave you a better understanding of KZIA, do me a huge favor. Please subscribe, like, and share. We're here to bring you unbiased looks at opportunities like this every single day so you can be smarter with your money. Hey, one more thing before you go. If there's a specific stock or ticker symbol you've been wondering about and you want us to give it the deep dive treatment just like this, drop it in the comments below. We read every single one. Thanks for watching, and we'll see you on the next one.